afternoon, everyone. Thank you for joining the very first Dolfin webinar session dedicated to sustainable investments. I'm delighted to be joined today by Monica, the co-founder and partner of Corner Capital, one of the pioneer venture firms dedicated to financial inclusion in emerging markets, and Adam, senior relations manager from Triodos, the first sustainable and ethical bank. Monica and Adam, would you like to introduce yourself quickly?
Thank you, Andy. It's a pleasure to be here. Monica Brand-Engel, as Andy said, co-founding partner of Corner Capital. Lovely to be here.
Adam Robbins, yeah, lovely to be here. Hope everyone's well. Senior Investor Relations Manager for Triodos Investment Management here in the UK.
Thank you for your introduction. So we're already a few months in, ever since the first outbreak in China, and now we have already been working from home for some time, and still every day, waiting impatiently for the next government's announcement. And I'm sure you guys have already attended many webinars where people talk about, how challenging the current times are, and how the outlook of global growth is clouding. So today I actually would like to open the webinar slightly differently by showing you a picture. You guys are probably wondering, why sky? Why blue sky? Yes, it's the main image of blue sky. I mean, this is actually how you can see the sky these days across a lot of different countries, including India and China. In fact, NASA has provided some data and nice images to show how the level of pollution has dropped dramatically. So no planes, no cars, and no fossil fuels. For those, those of you who have been to China or India, will probably know it's pretty rare to be able to see such a nice blue sky in big cities due to pollution. Even if, like, these days it seems like after China has been opening its economy, is returning to the pre-coronavirus levels in the major cities. So coronavirus has highlighted the importance of certain burning matters, such as climate change, that already existed before the pandemic. So yes, it certainly also has changed the world's landscape on different fronts of political, economic, and social. And it has also heavily affected everyone's daily life. And recently it also has caused volatility in financial markets, both private and public, for sure. So today I would like to start the discussion by asking the panelists and the audience, which I'm sure there are loads of impact investors among the audience. Do people still care about impact during the crisis time, even if the markets are tanking and the companies are struggling? Monica, would you like to give us some insight on what you see on from your end?
Sure, thank you, Annie. I definitely think there has been a growing awareness around impact, and I think, like many things with COVID, the crisis, the pandemic, has only heightened a focus that has already been bubbling up. So the way I've described it is there's a flight to quality. So just the way people are appreciating clear skies and what that means and the impact of their actions, people are thinking through and double clicking. So I definitely think that there's awareness, one, because people see suffering. So the small business, it's very next door. So the small business down the street that has to shutter its building, the unemployment lines that we see. So I do think it's a very visible reality of disparities and inequalities, and I will call it exclusion, that has happened, again, sometimes unintentionally, sometimes because policies haven't been thoughtful. It's made it very real. And so we have seen a really amazing response to what we're doing, both by our investors as well as our companies who, even with limited resources, even with tightening their belts, are finding ways to participate in relief efforts. That is a little bit tied to that we are a digital solution, so we're about technology-enabled innovation. So in times where you're physically limited, using online tools is a natural solution. So part of it is a little bit the nature of the kind of investing we do, but I also think it's an awareness, very much. I think your metaphor was spot on of this. Our eyes are opening of what's happening.
And what about you, Adam? I know you guys also have listed funds and products. So
Yeah,
with
thanks, Annie. I mean, I would echo exactly what you said, Monica. I think the current crisis and pandemic has really just opened people's eyes, and it's created more awareness around the climate crisis as well. So as you mentioned, Annie, we're impact investors. That's all we do, and we have impact investment solutions across the public and private markets. And on the public side, the way that we actually structure our portfolios, high conviction, long only, and there needs to be complete materiality around the sustainability and impact of a company, means that we've always had a fundamental belief in this sector, sustainability and impact. What we've seen is that our clients, on the listed side, our investors, be they retail, be they institutional, be they foundation, family office, whoever it may be, have been extremely supportive and focused of positive impact investing and sustainable solutions, and have continued, so in some cases, to double down. So we've seen positive inflows throughout the majority of this COVID crisis, which in itself speaks volumes, I believe. And I think also, if you look at the fact that there were huge outflows in the market in general, especially across listed funds, etc. I think it was something in the region of $400 billion was withdrawn from funds in Q1. Whilst at the same time as the crisis was taking hold, around 40 billion was actually invested in sustainable funds and that particular sector. So it's a real testament to people's recognition that there is a better way of investing, and as I said, we certainly haven't seen any particularly panicky reactions apart from the volatility in the market.
It's interesting because I also have recently read some articles that the ESG funds in general, they have seen less outflows than other funds. In fact, we'll come back to also this, which is linked to the general, performance of the ESG sectors during crisis time. But we'll come back on this later during the discussion. But I guess, my question was, a bit provocative and rhetoric question, because I do also strongly believe, that impact investors do care about impact. If anything, they care more about impact right now during crisis time than ever. And this is actually a good time for them to make a huge difference. We can't just sit there and wait for, the government and central banks and international organizations to action on this. It's a time, it has become quite clear that actually private sector can use its own power to drive the change also. Foundations, as you mentioned, Adam, foundations, philanthropists, impact investors, so now also our Dolfin private clients, they can play a crucial role, in responding to COVID emergency and help the communities to build resilience around the world. So, the underserved, under-resourced communities, like the discussion I had with Monica a while ago, those are the normal audience of impact companies. And those are also the people, who are more in need right now. I remember we just celebrated, the Earth Day also on the 22nd of April. I was just putting on a chat of my company, telling everyone, "Oh, happy Earth Day," and some of my friends do something for the planet today. I think the coronavirus crisis actually has, as I've mentioned in the opening, highlighted the importance of a lot of factors that people should be paying attention to. So now, assuming that investors actually care about impact and should be caring about impact, they still have to face the volatility in the markets. We all have seen, the pressure in both, private and public markets, and especially companies' valuation. They're under severe pressure because there's genuine lack of visibility of economic recovery, which also has been reflected in the pricing and general market reaction. So, what have you seen on your end for your portfolio companies? Have you had to go through discount and revisit your growth forecast?
Yeah, no, it's a great question. And I think, Adam touched upon a little bit in his response where he talked about he saw redemptions, but also overall net increase in subscriptions. And I think valuation is the same story. We definitely have had, I would say, the full gamut. So there have been companies, and remember, I will also just maybe preface to remind people, obviously, but it's important that, valuations, we like to think of it as somehow this objective reflection of the integral value of an asset. But the reality, it's a supply and demand. I mean, anyone who's bought a house in a hot neighborhood or, had something that was coveted knows this, right? It's why water costs much less than diamonds, even though we all need water to live, right? So so it's important to say that because absolutely there has been a hit, and that's because the demand for assets as people have liquidity issues. So even though I think there is a flight to quality, I don't undermine anything we said earlier about overall awareness and increase excitement about impact. There's a current liquidity need, and for many, their belts are tighter. Their belts are tighter because their own portfolios are suffering. Their belts are tighter because there is lack of movement, economic activity, and so because of that, and the very important macro factor that affects our portfolio, there was a level of leverage in the global capital markets pre-crisis that really impacted us importantly, because half of our portfolio are alternative lenders. They themselves are balance sheet providers. They are like a Cabbage or they basically provide small business lending through digital channels, or other or InsurTech, through digital channels. So because they have balance sheet as part of their business, they require capital, working capital, not equity investments, but debt. And so as a result, that has really impacted valuations. There are some companies where I would say they're more COVID proof, that they, for example, maybe don't have exposure to the small business sector, or because they are about e-commerce, they're tied to digital solutions, they've seen demand grow. An example would be InsurTech. We have a company in Thailand that provides health insurance, and a counter-cyclical impact. So valuations have been impacted, and the last thing I'll say about that is it works two ways, in that we're buyers as well as sellers. We are very conservative in how we manage. We don't take startup risk. We are a scale-up venture investor, but we aren't, we are not indiscriminate. We pick specific countries and specific theses that we pursue, and we do scale-up stage, not startup stage. So as a result, we have a lot of dry powder. And so we also are buyers, and so it impacts us positively in terms of the prices we're seeing for certain assets.
Just like to follow on what you were saying, Monica, because you're specialized in emerging markets, which is a little bit different from Churros. What do you think is the main difference? We can't bundle them all inside, the basket of emerging countries. But on your end, what you've been seeing on emerging market side?
No, that's a great question. So partly, again, supply and demand. There has been increased interest in emerging markets, especially on the scale-up fintech stage. Developed markets like Europe and the US become quite frothy. So we had seen already some flight to our emerging markets, but I would call it a sort of a running with a blindfold, meaning they were running there, but not really from a place of deep insight and knowledge, which is why we spend a lot of time talking to our venture peers in Silicon Valley and London and helping them kind of navigate this sort of market. So I will say, when things got unstable, there's a quick retreat. So I will say there has been the immediate reaction is retreat, but we see now people coming back as they see, wow, if you look at asset, relative to price, there is still an interesting opportunity here. And as you see how some emerging market governments have responded, I would argue more responsibly and thoughtfully. Look at how Asia has responded in terms of really flattening the curve. I would say they've been models. And so people are saying, it isn't, the West doesn't only have the dominance on stability and management and rule of law. So I think the crisis has a way of, we say in the United States, separating the wheat from the chaff, like really, or another Texas saying, sizzle from steak. We're about the steak. Sorry for environmentalists, I don't want to use a meat metaphor, but this idea of really back to the flight to quality. And I think there are some emerging markets that are not managing it well, and there are others that I think are managing it as the model.
Adam, would you like to chip in with
Yeah, thanks both. Again, just to echo that, Monica, we're seeing a similar situation in our emerging market private funds as well. It's exactly the same. And we're also seeing, again, going back to the original question around conviction and impact investing, we are seeing increased allocations into that sector, as well as support and continued holdings growing with existing investors as well. So that there is continued support, and there is a recognition that actually there is also, as you said, upside potential in the emerging markets as well at this point, because it works both ways. Absolutely. Now, if you look at the listed space, the public markets, we've seen some very severe equity market corrections. Our view is very much that some of the upcoming negative effects have not been fully priced in to the financial markets yet. There is probably going to be more to come. We also think it's substantial negative earnings are still in the pipeline for a lot of companies. And if you look at the incoming economic data, probably over the next few weeks and a bit longer, it's also likely to indicate there's more trouble ahead. If you look at the way the markets are behaving, it's not logical at this moment in time. It really isn't logical at this moment in time. You mentioned the liquidity side of things, Monica, and that sums it up perfectly. And I think also underlying that, the uncertainty about the duration of the pandemic and the overall consequences economically could well lead to new spikes in volatility as well. And linking that back into to valuations, clearly there will be a flight to quality at certain times. But at the same time, there are a lot of really strong, impactful listed companies out there that are creating additionality and have an intentionality that people will be looking at to double down on as well. We've been pretty defensive for a while on the listed side, and we're going to continue to do that, because we think that's one of the easiest ways to guard against the corrections. But we will continue to invest in companies with solid impact and sustainability fundamentals, sound balance sheets, strong management teams, and decent cash flow visibility. And our view very much is that if you're looking at sustainable companies, they will have all of those as indicators as part of the materiality assessment, and that will make them good from a valuation point of view. And they will also be looking to, they will be generating alpha moving forward as well.
Yeah, you've mentioned, the two features that are quite important to classify companies as impact or ESG, intentionality and additionality. So like on the equity side, because just the general equity markets, because people think still the valuation is still quite expensive and waiting for a further correction. Do you think also the equity impact equity space also will go through further correction in terms of valuation?
My view is probably not. Not very convincing, but probably not. I don't think it will. I think if you look at how things played out in the first quarter, not only was there positive inflow into the kind of listed sustainability funds, the public market side, but there was also good relative outperformance against the global benchmarks. And some of that was down to some of the sectoral bias in the funds, where there's no involvement in fossil fuel, quite a lot of financials, et cetera. But clearly some of that outperformance is generated via the positive upsides from those stocks as well. So I genuinely believe that when the next correction comes, sustainable impact listed funds will be in a much stronger position again to weather that downturn. Because again, you go back to the point of the fundamentals of the company, a good corporate structure, a good team in place, and they are weathering the storm. And a lot of the sustainable companies that we're looking at, talking about additionality and intentionality, they're looking to produce products or services, or they have business models that are going towards solving a transition theme, a sustainability issue that we have globally. And therefore, those products and services and models are going to be in demand moving forward, as you said, because really this crisis is just highlighted and brought to everyone's attention the bigger overall kind of economic picture that's taking place with climate risk, etc. So yeah.
Yeah, also on Dolfin side, we have been focusing on mainly the resilient companies. In fact, we did mention also in our past investment updates about the resilience and recovery baskets, specifically about companies who are resilient to the COVID crisis. I mean, probably on the private investment side, the private clients have been quite cautious of about deploying into more liquid investment, especially during crisis time. And it seems like we're heading into a recession that no one knows if it's going to be worse than before. And also valuations even have come down, and it will probably take longer for private companies to get listed. So I think on our end, we've been seeing more for sure cautious behavior on the private investment side. I think also you both have touched on the point that the new darlings will be different. For example, the new VC darlings, I think they'll be different one, like focusing on more like digital services, like on the new rules of the world, and healthcare, etc. Monica, are you seeing like new sort of business models or new darlings coming out?
Definitely, and well, I would say new and evolutions. I would say both. So on the new side, we do see a lot of innovation on how do you use digital payments and e-commerce to basically deliver sort of do small business in a different way. I mean, example, we just made an investment in a company called Soko Watch in Kenya. And basically they are trying to solve the last mile logistics problem. So, thinking about supply chains. So there's been a lot of conversations on how COVID has disrupted supply chains. A farm that is supplying to a restaurant or a supermarket packages things in a certain way that make it hard if you're now delivering to a consumer directly. It's not so simple, right? How do you get it, in a biteable, sort of delivery, both how do you get it to the person and how do you package it in a way without building a new factory? So sort of, even some things we see in the West are accentuated in emerging markets where there's a very underdeveloped infrastructure to begin with. So Soko Watch provides both last mile logistics, but it bundles it with other services like data. For example, we've never really thought about how do you provide intelligence to that small business, that corner store, to think about how do they stock their shelves. And we expect Walmart and large companies to use data analytics very deeply to make sure that they are, and that's how they're able to deliver products so cheaply. But those same benefits don't accrue to small mom and pop shops. So trying to bring the power of e-commerce to the end of the value chain, the last mile, that's their basic business model. And so even their existence, and in fact, we invested in another one in Indonesia, it's called Ola, another one we looked at one in Colombia. So we're seeing business models that really don't have an analog in the West kind of pop up, and they're a response to a specific pain point in emerging markets. But the interesting thing about the evolution is that then brings an evolution to how we think about financial service delivery. What do I mean? Lending, for example, the first generation, you would just have very much like an OnDeck or a Cabbage, an online lending facility. So I need a small business loan. Rather than having a loan officer go out and visit your shop, you do everything digitally. You acquire the customers through digital marketing, you underwrite using alternative data, and you collect using digital payments. But what if we tie that loan to a use case? For example, the way Uber launched a credit card for its small business drivers. So the idea of tying mobility and transportation services to a financial service, or tying e-commerce, the way eBay and PayPal merged originally. So this idea of tying, not having financial service be a standalone product, but embedding it in another value-added service for the customer, whether the customer is a small business or a consumer, is a very interesting evolution that we're seeing increasing. So banks, I think the financial institutions of the future, it's why Facebook has financial services and Amazon. It's not just Citibank and Bank of America. So even the players who are playing in financial services are evolving. And I actually think that's exciting. I think it means that because each of those entities have different strengths and different services they can bring to consumers. So I think the winner in all of this is the customer, hopefully with lower prices, more diverse service, and just more competitors. I do think banks have suffered from a little bit being too chummy, and this idea of broadening and opening is, I think, very positive.
Yeah, I think we also during one of our internal discussions about e-commerce, we did in fact discuss about the fact that there's a dramatic increase of online transactions because of the e-commerce. Everyone, of course, is locked down at home now, and if we are heading towards a cashless world where cash is not necessary anymore. It used to be a topic a few years ago, well, even like recently, when people were talking about cryptocurrencies. So is that, coming back as a topic again, since we're heading to a completely different world. Adam, do you have, what are your thoughts on this?
Pardon, Annie, could you say that again?
Yeah, so like we're just mentioning about, if the more innovative business models, e-commerce and focusing on different sectors than just the traditional ones, and we're heading towards more like a cashless world.
Yeah. Again, if you look at the way we build our portfolios on the listed side, as I said, we've got key transition themes that we're looking to support effectively towards a sustainable future, and things around innovation for sustainability, sustainable mobility and infrastructure. So we're looking for publicly listed companies that are really helping to kind of push things forward around that. If you look at something that links into sustainable mobility and infrastructure, that's very relevant with talking about this term that's come out here in the UK, very clearly build back better, and the links to trying to make things more sustainable moving forward. We have a position in Shimano as an example. They're a bike component manufacturer. And we've always believed that that's a fantastic stock as a company. It's extremely well run. Financially, the metrics and the valuations are spot on as well. But then you see what's happened as a result of this crisis, and you see that, you look at London, you look at Milan, you look at Paris. Many of these countries are going to start removing potentially traffic from city centres and looking at cycling as a very credible alternative. So again, our view very much is that many of these companies don't need to be completely reinventing the wheel as well. They could already be doing something extremely valuable. And clearly, as circumstances change, they've already positioned themselves ahead of the curve for that move to what's going to be required as the next technology, or the next fundamental investments.
So it's quite funny that you've mentioned about cycling, because I just managed to get a bike before the quarantine, and I'm so glad I did it. It's the only thing that I can do these days, and it's just been so nice to cycle around London without any traffic, because we all know it's actually quite dangerous to cycle around London because the buses
Absolutely.
have so many cars, and it has been really nice. And it's also linked back to the very the beginning of the blue skies. It's are we heading towards that direction, less traffic, or just different alternative ways of commuting?
Yep.
Have to go to work every day. I think before the crisis, a lot of investors at least were focusing a lot on the E of ESG factors, like a climate change. But I think now people are also emphasizing also more the S factor, or the G.
Yep.
In fact, like how the companies are responding to the coronavirus, for sure they're getting a lot of attention. They will get greater scrutiny, because I think we will face stricter regulatory requirements. Consumers are getting more sophisticated. Pressure groups are getting more sophisticated. It's just showing that we're going through a different level of awareness. Also, I think few issues like shares buyback, executive remuneration, human capital, these will be key components, factors going forward. I was just reading, the article the other day saying that, during coronavirus time, only 6% of the top 100 US companies actually have been committed to cut the executive pay, which is a shame. I know a lot of companies have stopped doing the share buybacks because basically the whole purpose is just to pay the dividends to the shareholders. I think investors are watching these issues more closely for sure. I mean, what do you guys think on for your portfolio companies, how they're responding to the crisis? Besides having a for sure innovative business model, but how they're taking actions to make sure everything is, for example, employees are well at the company, etc., etc.
Yeah, and I think this is another differentiating factor of impact investing, that how you treat people is sort of, again, a core part of the diligence we do up front. It's certainly something we actively build into our governance function. We usually create an HR committee along with a kind of audit and risk committee. Those are the two fundamental issues that we're always sort of trying to be very vigilant on and aware of. And the nice thing is that you don't have to insist on this. I think the people we invest in are by nature have a proclivity to think about what are the inequalities that are already built in, not only for our customers, but even how we run our business. We had actually organized, unfortunately it was disrupted by COVID, but Women in FinTech in South Africa, and actually all of our tech companies. And unfortunately, we're in a world, just if you take gender lens as one part of the S, financial services and technology are both, unfortunately, arenas where women haven't made as many advances as other fields, like medicine, for example, where you see, sort of a much more even split. And so there's a real awareness, and that has a lot of reasons in terms of engineering and STEM in general, and why there are gender differences in those graduate programs and programming and computing. And so there's a lot, it's a multifaceted point. But what you see is a real recognition that that's something they want to change, because their end customers are more diverse and want to make sure that their staff reflects kind of the insights of their end customers. So it's not an affirmative action question. It's not a social justice statement. It's actually, how can I run the best company? And how can I respond real time in an insightful, aligned way with and actually anticipate what my customers need? And so it's a very thoughtful approach. Similarly, when we had to cut, and most of our companies have had to tighten their belts around staffing. Some of it's furloughs, some of it's actually, early retirement of underperformers. But in all cases, it's difficult because the intention, everyone, when you work in a mission-related company, everyone's trying, right? There's very few people who are just completely kicking back, but there are, people who are not performing. And so just the thoughtfulness and the way it has been done, almost over and above what labor law requires in terms of severance and notification. I mean, all those things are clearly things we watch as well. But just the thoughtfulness and really trying to set the person up for success in their next endeavor. I have to say, I'm nothing but proud. I mean, it's, you see, as I said earlier, adversity sometimes brings out new muscles in people. And it's just been, not to make light of how difficult it must be, but it really heartwarming.
Yeah, I would agree with that, Monica. I think you've hit the nail on the head completely there. And Anna, you talked about share buybacks and dividends, etc. We're calling for any kind of bailouts to companies effectively to be tied to environmental performance, carbon reduction, carbon emissions, climate reduction. And I think people, as you alluded to earlier, Monica, the general populace are getting more and more used to accessing information and are becoming more and more aware of what's happening. And I think it's going to sit particularly uncomfortably with most people to look at companies that have taken bailouts and still provide dividend payments, or look at making large numbers of redundancies, or excessive remuneration. And I think looking at the ESG fundamentals of a company to invest in will hopefully ensure that those companies themselves are behaving better and have a better structure in place. But I think we probably all agree that it also needs to go deeper than ESG as well. You really need to be looking at the purpose of the company and the way they treat their employees. And we know that just ESG ratings are a bit of a mixed bag. So it's about interacting with those companies to actually understand the fundamental structure, what they're trying to achieve, their impact stories, talking to them and understanding their business model, their strategy moving forward, and kind of, how they act in a simplest term, because that's an extremely important part of selecting successful companies moving forward. A good corporate structure, as we said before, should protect against some of those issues. But lack of cash, lack of liquidity, bad management, and the necessity for buybacks, etc. I think the other thing to mention, of course, is this is an economic crisis, but it's a systemic crisis. I think we're looking at the fact that we don't have any buffers, really, financially, socially, and ecologically. We're kind of on the limits of a lot of things here. We lack diversity in the way we produce things and the supply chains we have. We're dependent on economic growth, and that needs to change a little bit potentially as well. And clearly, you can see that we've got health effects and risks that are very much unevenly spread between and within countries as well. And I think looking at companies, both definitely on the private market side, where it's really tangible and focused on the real local economy, and you can see the benefits, as you mentioned, around gender inclusion and ensuring no poverty, etc. It's a bit different on the public space, but again, by looking at strong ESG fundamentals and positive impact factors, it is possible to really ensure that most companies are being held accountable for having a good S as well as just an E, and the G will play into that. They are all interlinked.
Yeah, I think it's a very interesting point. Like, until now, people have always, segmented different factors. I think people should start to see the interconnection of all these factors instead, and come up with a value creation chain to make impact instead of focusing on single components. And people should think, should start to challenge the status quo of all these big companies and rethink the way of doing business. In fact, I mean, it's crisis time, but it's also very interesting, moment to test the ESG and impact hypothesis. We not all know they're good risk management factors and themes, so they should eventually help the companies to experience, less volatility in the market, and have more resilience and lower incidence of controversies. So I think I was checking on some data on the MSCI. They're actually quite encouraging data showing that ESG companies are doing well and they're being outperforming. So, for example, the MSCI ESG leader indices have outperformed their mainstream counterparts in most of the geographies. And it's the same for UK. For example, the UK FTSE 100 ESG leaders index has outperformed the FTSE 100 significantly year to date. And they also, these impact companies have seen smaller EPS cut than the big laggards. And you both have mentioned that, like the ESG funds and ETFs have experienced smaller outflow compared to the traditional funds. So, so do you think we already have enough data, especially now, combining the financial crisis and the COVID times, to support the general thesis of outperformance of ESG and impact investment, and and if the short-term outperformance is sustainable on the long run?
So I love this question, and being very data-driven in our approach, I do think it's important to look at the data. And so we certainly, so for example, let me just share some data points because I think it's important to be very specific. I think sometimes impact investing, I think, and I would not accuse Dolfin of this, but there are other players that make very broad sweeping statements, and I think we lose our credibility. So what I would say is we benchmark ourselves against Cambridge Associates venture data. So we use MSCI, the Morgan Stanley index. We use commercial index for appropriate asset classes, in our case, emerging market and growth stage private equity or venture, to the extent it exists. And remember, venture is a very new asset class in many of our markets, so there's not really fair comps. So a little bit, so the comps are not perfect. But if you compare ourselves, we're in the top 25%, and we actually our target is top decile. So we have consistently performed. If you look at our gross to net IRRs on our first funds right now, we've had 3 exits, even though we're still in our investment period. We have not, obviously the key killer return is cash on cash. We're in year 4, starting year 5, so it's still young. But if you look at any benchmark relative to our peers, vintage year, right market, we're outperforming. Or we're in the top again, top quartile, moving to the top decile is where we are. Now, broadly, that's true, and then we're not the only ones. There are many, and I'm sure Adam can share Triodos's performance. There are many impact funds that are outperforming or in the top decile or quartile of their peer group. Now, I think that the danger comes when we start comparing, fixed income to equity, and so I've seen a lot of messy. I think we have to be really thoughtful. But in general, what I will say emphatically, with no qualification, is that I don't think there has to be a trade-off. Empirically, we have proven that you can invest profitably in impact-oriented managers. But the key, like in private equity, in normal terms, there are good managers and bad managers. And if you pick a bad manager that's not focused on performance, you're not going to do well. So I think, again, this idea that somehow impact shields you from poor performance is not true. There are underperforming impact managers. I need to say that. And so it's very important to say, so I think you should do I think your listeners should do their diligence, talk to smart advisors who really do blanket the field and double click on hundreds of managers before they choose one. And so I wanted to, I hope that's not, I didn't want to just say yes, because I think that's a dangerous statement, because then people will look at an underperforming manager and say, oh, this is a PR statement. They're not being honest. And again, I think there are high performing managers where you sacrifice nothing. And arguably, and I'll even go further, I would say we're a source of alpha. I said, if you look at our theories, like if you look at the markets we're going after, the theses we're going after, I went to Stanford Business School, and a lot of my colleagues are in venture, and I'll take them on any day in terms of our performance. And it's because I'm not trying to win in the top 1%. I'm trying to win with the 90%. So my odds are much, much better. So again, I under promise, over deliver. So there's a reason why we over deliver. It's because we look at very large addressable markets, solving pretty fundamental problems in markets where there's not a lot of competition. So again, call me a genius, but that seems like a winning formula. And I think I don't think we're alone in terms of smart impact investors that are putting smart bets in responsible ways in winning formulas.
Yeah. I mean, if you look at the public side, keep it nice and succinct. So, our view is that just companies that consider environmental, social factors and abide by really good, solid standards of corporate governance are going to be better equipped to ride out any downturn and quickly get back up to speed. It's just good corporate governance, and it makes sense. You mentioned earlier, Annie, that during the severe volatility and market declines that we experienced as COVID took hold, sustainable and impact funds held up much more strongly than the main indices. So we've been running impact investment solutions for in excess of 25 years. We've got almost €5 billion under management. And throughout that entire time, we've always looked to make a return that is at least in line with the market. So we, agree with you completely, Monica. This old misnomer that you have to give up some return to do good with your money is gone. Those days are completely gone. That's philanthropy, and that's different. If you look at our funds, we outperformed relative to the benchmarks and our peer group in Q1 when the severe volatility took place. And we're slightly behind at this moment in April, but then clearly, our view very much is that we've positioned ourselves defensively as well. So we're sticking to our convictions, and we believe, as you mentioned, Monica, that the investments that we have, the positions that we have, are going to be those leaders of the future. They are going to be the ones that drive the recovery and bring the economy and the global economy back up and move forward. Going back to your point as well around the alpha, this isn't just about managing downside risk. This is about the alpha as well. Our view is that the sustainability story is the equity story here. And we very much believe in that fundamental approach, definitely. So yeah.
That's also the key point. I keep telling my clients also, it's making social returns doesn't mean necessarily sacrificing financial return. In fact, that's the whole point, doing the impact investment, because you can have both, and then you can actually create alpha through your investment strategy.
Absolutely. Just going back to that point, sorry, very quickly, Annie, as well. Yeah. As I said, we measure against the main indices with our listed funds. We're not measuring against another ESG metric or the FTSE for Good or something. We're against the MSCI World, because we believe that actually that's what it needs to be pitched around to convince those that are not already in the room for impact investing that actually it stacks up completely as an investment as well.
Okay. I'm being conscious of time because we are actually running a little bit late. So I'm just going to throw out the last question to the panelists, because I've touched also on the alpha creation strategies. Do you guys want to share some tips maybe for our investors to how to approach the impact investment going forward?
I'll share what we do at Quona. Number one, all the partners of Quona have been operators and investors in the markets where we work. So that what that means is that we've actually lived, I'm half Peruvian, I've lived in Mexico, India, South Africa. We've run and scaled companies in financial services, in technology, in emerging markets. So the idea of actually knowing your market, knowing your customer is number one. I think you have to do this from a depth of humility and what I call a beginner's mind, really being curious and understanding why are people doing things and behaving ways that isn't different than what I predict. Because when you do that and you figure out who is what I call the positive deviant, bucking the norm, that's where sources of alpha are. Number two is we call it being kind of mechanics. We look under the hood. So, we look beyond the pitch deck and look at KPIs. We're super data driven, key performance indicators, really trying to understand what are the drivers of this business, what are the unit economics, how does that scale, how does that relate to capital needs? So again, a lot of data. To make smart bets. I mean, obviously venture is a betting game because you're betting on the future, not the past. But the idea of how can you make very, very educated bets and be very thoughtful with your money. And number three is, I would say, act with integrity. So you do what you say, see what you say what you do what you say. And that means when we present term sheets, there's no fancy financial engineering. It is very classic, National Venture Capital Association, sort of structure, very clear terms, nothing, hidden in the fine print. That's not how you win deals. We don't believe that. I mean, I'm sure there are some people who win that way through fine print and through financial engineering, through a lot of complex structures. That is not our approach. We build great businesses, and so that lots of buyers.
Yeah, Adam, do you want to share something?
Okay, yeah. So I wasn't sure if Monica had finished then. So yeah, absolutely. I mean, again, just echoing this, as I said, being a pure play impact investment manager is all we do, and it's our belief that the way one invests defines the world that they want to live in. So that fundamentally is what we do, and working across that philosophy, across all the capital we manage, sustainability is absolutely embedded in the core of all of our portfolios, both public and private. And in order to really generate that alpha on the listed side, we're looking at a proper integrated business model analysis as well. So as I said, it's not just a company that ticks very highly on the sustainability side, it has to be financial as well. And it's our belief that the material sustainability factors on company value drivers like revenues, capital needs, margins, cost of capital, as well as the impact in ESG data for the organization, really link into that financial and risk data as well. So it's about the whole company, and yeah, as I said, clearly, if you look at let's just think about what the word sustainable means as well. That in itself for me has always been a good indication of why we invest in these companies, because they are sustainable, and they will see out the crisis and be well positioned to move forward beyond.
Thank you, Monica and Adam, for your insight today. Just to conclude, today's discussion on a positive note, since we have been bombarded with enough negative news, all these uncertainties around our lives, I think coronavirus crisis is actually sparking innovative and entrepreneurial ideas for building a more sustainable, future for all of us, and more scalable, healthcare services and digital solutions. So I think impact investors should express themselves now to help to shape a better future. And actually, it's actually quite comforting to see that more and more organizations have adopted principles for impact management since the COVID outbreak. And we are hoping to see, acceleration of the industry consensus for both ESG and impact. And a lot of actually big asset managers have been launching impact funds in 2020, like KKR, BlackRock, those big names. So I personally remain a big believer of ESG and impact investing. And the Dolfin as a company is also really focused on the impact strategy for the second half of the year. So I hope altogether we can contribute to make this world a better, different and a better place tomorrow. Thank you for your time today. We're ready to take some questions from the
Annie, there are quite, I was gonna say, I saw some questions on the Q&A.
Yeah.
So we're going to take some questions from the audience. Let's see what we have. So the first one, does the increase in energy consumption driven by the digitalization of the economy a variable considered in impact and ESG investing? And would you invest in data center, for example, given all the fundamentals being taken boxes?
If you look at the analysis of the companies that we invest in, we're looking at all of it because it's connectivity of everything, and the performance overall. So we would look at something like a data center provider or a tech firm like that, and whilst they could clearly be contributing hugely to innovation for sustainability, or even links to sustainability for mobility and infrastructure by reducing the need for this. Clearly, if there's a huge negative attachment to that company from the GHG emissions, and they don't have any form of plan in place, or it's not baked into the strategy of the company to reduce those emissions, then for us, that organization is not impactful. It's not having a positive impact. It really is about looking across the board at everything, and it comes back to what we've all talked about previously, that E, S, and G are not separate.
Thank you for your insight. So let's just answer to another question, because I'm conscious we have only 4 minutes left. So the second question, other questions that we can address them privately, you can send us an email. We can reply to you by email. So the second question, are you seeing differences at the regional level in the level of interest in ESG impact investing across emerging frontier markets? Is Asia more advanced than Latin America in this space, for example?
We work in Asia, Latin America, and Sub-Saharan Africa, and the interest has been strong and remains so. There are regional differences, but I wouldn't say it's more or less. It's more on what sectors. For example, in Sub-Saharan Africa, a lot of interest in infrastructure, mobility, and logistics as it ties to financial services. In Asia, digital payments and healthcare systems, so another type of embedded financial services are quite interesting. In Latin America, we see a lot of alternative lending, or what I call neobanks. So basically becoming entire banks that are digital. So I wouldn't say it's more or less, but there are differences.
But completely echo that. We see exactly the same across our emerging markets, from renewable energy to to financial inclusion as well. It's exactly the same. The geography plays a part on what's driving the requirements effectively.
Okay, I'll just make a quick comment to the third question, because related to Dolfin. So someone's asking, does Dolfin have any impact investment products? So I'm in the process of building the impact framework at Dolfin, as you both are aware of, which includes also building a product pipeline. So guys, stay tuned. We will come up with a proper offering soon, both on the private and listed side. With that, I would like to thank everyone for your time today, and I'll speak to you very soon, for sure, for the next episode of Impact Investment Series.
Thank you so much, Annie.
Thanks, Annie. Thank you, everyone. Great questions.
Cheers.
Bye.
Bye.